Okay. Alrighty.
All right. I don't have all of my stuff loaded here.
Okay.
It's all right. There we go.
Let's see if we can get a bounce on a spot.
What
I
a podcast.
got one more cover
Watching
here.
the market open. Powell is speaking today before Congress, same as yesterday, so nothing exciting there. It is going to be kind of probably another chop day, honestly. I don't think that anything he says is going to really move the market. We don't have any economic insight other than this gas tax nonsense that Biden is talking about. It seems so ridiculous. I'm going to throw this up on the screen here. I'll throw me up on the screen. S&P is up 0.6%. Looks like we're trying to chop this morning up. Same with Aapl here. Choppy.
All right.
UPRO
covered puts up 75%.
Biden administration is going to suspend the gas tax that you pay at the pump, which should be anywhere from like 11 to 18 cents per gallon. Just gas is up like $2.50 to $3 a gallon. 18 cents seems so stupid. Like, oh, we're gonna have relief at the pump. Okay, you do that, buddy. You do you. Let's see what the boys are doing today. Traded with them yesterday.
All right, let's SPY back up here. All right, so we're seeing some chop so far. Let the market flesh out a little bit here.
We're gonna rally on this gas tax news.
QQ covered call should start really kicking in here.
Just wait, buddy. Biden just cut 18 cents off your gas per gallon bill. It's gonna moon.
Well, I hope it doesn't bring Tesla with it.
Tesla, oof, down below 700 is gonna be back to the shit show, huh?
Yeah.
It's looking like puts time in the morning. I don't know. See if it bounces off of this thing. What's my EMA look like? Yeah, I thought that was a pretty nice joke. Ooh. SPX is that bearish reversal zone is right there, huh?
TQQ covered calls just closed for 65%. Beautiful. Holy cow. Okay. All right. What do we start morning?
Damn, look at that thing go. Boom. $3.20. Wow. All right. There goes all your freaking pre-market gains, huh?
Covered calls getting close for TQQ. Another round. 78%. Oh, okay. Goodbye. Okay. All right. Adios to those guys. All right. Damn. Market chopping. Market popping. Market dropping. We still pop.
Where's the bounce? I don't know, man. SPX is in between that bearish reversal zone. It's bouncing off of that.
Yeah, we'll see how far we come down before we get a big bounce. QQQ's not looking good.
Wayfair call. Interesting.
Oh, Tesla's I'm about to be out of the money with that cover call again. Come on, Tesla, go to 650. Go to 650. Come on. Come on. All righty.
Tesla's about to bust that 7. Ooh, it's right there. There it goes. Below 7. Yikes. Freaking yikes, man.
Good. Let her fall. Let her fall. Now, I was down 390%. Now I'm only down 129%. But it's a covered call, so it doesn't matter. I'm still going to win. Love it.
Oh, what is this bull guy doing, bro?
What's he doing? What's he doing?
Wait, like some like
Wayfair call.
Bro, he needs to call some like puts on something.
Well, here's the beautiful part about our country, my good sir. If you don't like what he's doing, ignore him.
Do something else.
Yeah, I don't know.
What's crazy is that Wayfair contract, the spread is huge.
So
50 cent of that's 35-cent spread on that. That's high.
all right, let me just say this, folks. Bull is a good trader.
That's a great trader.
Yeah,
He's got a very interesting, but systematic process about going about his risk management as well as his gains, right? But the reason why we have multiple analysts is because we want to make sure that we have analysts that deploy different styles tailored to different folks, right? If I was a new trader, just because of my personal nature, I would avoid bull like the plague. Okay? I'm just going to make that clear. All right? That's just because of my nature. I am a 70-year-old man in a 23-year-old's body. I am unbelievably conservative with what I do. Okay? Make that clear. Now, if I'm a trader who likes to see amplified returns, likes to see what we call boom shakalakas, then I'm going after bull. Okay? I'm going after bull with the big guns, baby. But me, I'm conservative. And at that point in time, if I was a new person coming into the server, I most likely wouldn't know how to manage my risk that well. So I would probably have to have the critical thinking capability to realize that unless I manage my risk, I'm going to lose my ass. So.
That's a valuable asset.
I see what you did there. A valuable asset. I see what you did there. Very nice. All right, anyways. Does that make sense, guys? Just take some time, better understand who Bull is as a trader. And again, this is why I'm also implementing a long-term side into the Discord. Because I would like to make sure that we can market to everyone and provide a community that is fully sufficient for everyone. All right? And fully comprehensive. So, and that is the one thing that we primarily do not have in this server, except for me. We have long-term crypto guys. We got some longish term stock guys, but I'm...
There we go. Wait, call. Wait. What's it a call?
Say
What just said a call? Wait, hold up. Maybe.
I mean...
Oh, yeah, SPX.
Bull just said calls, and then Spy has an absolutely mountain candle.
Right.
I don't know if
What did you call out there? A 28, 38, 30?
If you cannot justify a reason for entering any of the analyst plays,
I can't for this one.
I'm saying this broadly. I'm not necessarily referring to you, my good sir, but you as well.
Yeah.
If you cannot justify a comprehensively round reason as to why you would get into a trade that he is alerting.
Yeah, not with that one.
Keeping a 100-yard football field between you and the trade. Right? The trades are here to guide you. Right? You have to develop your own risk management, which is why we are so heavy on education. So heavy on education.
Dude, it ate that candle. Jesus.
Yes, it did.
Wow.
So, guys, word to the wise. Okay? Right now, the market is chopping back and forth. We just had a monster candle, and guess what? That candle got eaten alive. So, just be careful.
Imagine if I took that call, bro.
Okay. Just all I'm saying is we are 12 minutes into the market. All right?
Mm-hmm.
Just y'all take it easy. Take a little deep breath. Address what interests you, and then move from there. Okay.
Yeah, I waited after that bottom of that candle, and I did a 38.25 for the same fill price that he had his.
Like a call?
Yeah. Because if it eats that red candle, I mean, look, that red candle is pretty aggressive. Eats that up, and that thing's up $60 already. So.
Wait, what makes you buy a call right now?
Bounce off of that bottom. Look at Aapl and all these other ones are starting to bounce right off of there.
Did you buy
That's
23rd of June?
$105.
Did you buy 23rd of June?
I did a 38.25.
No, look, what expiration date?
Oh, today. We're degen
Today?
Yeah, fucking today, bitch. Let's sell this
What's
thing
your-
immediately.
Sir, I'm gonna need you to be respectful for the non. Please, sir, please.
We're getting out of this thing in like 6 minutes.
Sir, I'm gonna have to simmer mute you, sir. You're gonna have to simmer down. Sir, you're about to get hardcore canceled, sir.
We are up $120 on that play, 135.
Oh, that would make sense.
Oh, I didn't get into that play.
And I'm gonna put my stop so that I don't get screwed out of this.
By doing that moonball.
Yeah, it is.
Hey guys, just a quick little note. If you all are doing covered calls on TQQ, please draw your attention to the theta of these contracts. The theta is equal amount of the premium. Let me repeat that. The theta is equal the amount of the premium. All right? So, today is Thursday. As long as you are not going in the money for your covered calls or right at the money, you can see the deltas of these positions. It's a very high probability you come out on top. That is why I am doing what I am doing. Free money.
And what are you doing?
What?
Nothing.
Covered calls. Covered calls.
I know.
Covered calls, man.
Wait, yo, I have a question. Wait, who's the guy? Like, if you go on TikTok, who's like the guy who the TikTok guy for OPR investing?
Griffin.
Huh?
That's Griffin, brother.
Does he trade as well, or is he like an analyst, or no?
So Griffin, yes, Griffin does trade, but Griffin's primary role within the company is social media. He is a marketer. Yep. Griffin's a very hardworking dude. Puts a lot of videos out, does a lot of content for us, grinds, brings a lot of folks in here because
holy.
Yeah, RIP whoever bought those like SPX calls or whatever. Like,
well, the calls that he posts on social medias are usually from the analysts.
Yeah, no, I'm talking about Big Bull, his old SPX 30 call.
Oh, it's 15 minutes into the market, bro. Good. That thing's barely
What's with
moving.
these God candles?
Now, his fill price on it wasn't great. I'll give him that.
I mean, I just made 300, so I'm chilling.
There you go. In and out?
Yes, sir.
Batches.
Mr. Clayton, sir. I'm in the office right now. My bad. I know you. If you don't mind me asking, how much is like this Discord make a month? If everyone pays like $30 or whatever.
Depends on how many premium boomers we have per month, my good sir.
Do y'all like split up like the revenue or?
Well, that's not necessarily public information. That's company internal information. And it depends on your role in the company. It depends on what you're doing, and it depends on value that you hold with the company. It also depends on duration of the time you've been with the company, just like any other.
Jeez, look at this candle.
Yeah, see, that's what I'm saying. Like, over here, like, bull's call, but buddy, look, it's back into business.
So choppy, bro. That's some sideways movement, I mean.
Yeah, well, expect that to be the scalper's market.
Just understand that there are times where bull is in a trade and out of a trade in seconds because he gets one. He gets one. Well, it's not his responsibility.
Right. Yeah, I mean, it'd be nice if he did say when he got out.
Well, I mean, think about it this way: if he's typing entries and exits, then by the time he's all the time that he's mentioning exits, then he's not able to provide entries because he's providing exits. So it's our job as analysts and as educators to make sure that you understand risk management and you understand when and where to be taking profit on your trades depending upon what the setup is, right? And if you're trading 13 minutes into the market, it's probably going to be about a 3-second trade. All right? So, again, the analysts are there to give you data. They are there to guide you. right? But it is up to you to make sure that you manage your own capital and risk. So the amount of people that yell at Bull and say, Bull, you made me lose money, blah, 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 happens all the time. The guy deals with a lot of shit.
Yeah, but look at his percentage averages are freaking awful.
Yeah, I swear, like I never get into his good plays. So, like it's 1,000% return. I swear, like.
Well, and a lot of times it's because people trade with smaller accounts, so they only have enough to take one, or they over leverage the one that they do take. And so he might post 8 trades a day. One of them goes deep red. That's the one you picked. The other one's
Exactly.
deep green, but you're out of buying power and you held on to the loser.
Right. You have to establish if you just want to trade Bulls trades, you have to establish your risk management with Bulls trades.
For sure.
If you can only lose $50 a trade, you might want to go for a much cheaper contract out of the money. But you have to assess how much you can risk per trade before you
Max,
trade Bulls. What's up?
No, I was just reading something bad.
You good? You got to make sure.
I am not gonna play earnings, bro. It's like the worst idea. Like I used to have a 5K account, but I blew 5K.
Okay, I'm gonna make this very clear. All right, and you guys can quote me on this, whatever you want to do. You should not be playing earnings unless you have over $100,000 account.
Well, I don't know. That's
no.
You can play earnings with $50.
Nope.
Crazy. $50 contracts.
Nope.
Money gone.
Nope. I am a monk, bro. I am a freaking monk.
I mean,
my rules are my law. I did not get to where I am by playing earnings.
Nope.
With a 10K account. Make that very clear. So, you do the work. You do what needs to be done. You build up the capital you need. You can be 100% financially self-sufficient in the stock market and never work another day in your life if you have $100,000 and you educate yourself.
Oh, for sure. Yeah, I think you could do that with $10,000, honestly.
Well, $10,000 would require day trading.
Well, yeah.
I'm talking about doing what I do.
I don't know what you do. You're here every day, so I'm just assuming you're day trading with us, selling covered positions.
Well, I'm day trading covered calls. You guys are day trading naked calls.
Right.
So it's just a different perspective. I like to put all of the variables in my favor rather than not in my favor, which is why I don't play earnings. And I have over the account requirements that I provided to you guys. So, that being said, if you all are trying to build your accounts, you should be taking the highest probability setups that you can navigate. That involves determining setups, being able to determine setups. That involves risk management. Okay? I know that most folks who come in through Griffin's marketing don't want to hear about risk management. They want to hear about turning their account 4x in 2 days.
Right.
I am here to tell you, first and foremost, now that you're in my live call and you're not on TikTok, that's not going to fucking happen. All right? It's not. You may get a boom shakalaka out of Bull, but then 2 weeks later, you're going to risk half your account on the next, what you think might be a boom shakalaka, and then you're in trouble.
Oh, yeah, for sure. Happened to Jacob.
Look at SPY. Uh-oh.
Yep, SPY's getting a little bit of a downward trend. It's actually bouncing off of that bearish reversal zone, so
Tesla.
Not all that surprised.
Give me my cover call money back. This is beautiful.
How much money do you have in your account?
Say it again.
How much money do you have in your account? Like how much do you trade with?
Do you think that that's a personal question?
Nah.
Why not?
How you feeling?
Whatever.
Start off with some push-ups.
So I manage a decent chunk of capital between myself and my
I
companies.
didn't
We'll
do
just
a
put it
whole
that
lot.
way.
I've just kind of helped her mostly.
Quite a decent chunk.
You hear me?
I can, yes, sir. What's up?
Yeah. Have you? Yeah, I was talking to you about like 3 weeks ago about doing weekly covered calls, but you were like you had no idea what I was talking about. So you're doing them now?
What's it? Is that Nick?
Yeah, it's Nick.
What's up, brother? No, I started my covered call journey running short-term covered calls.
Okay.
But until we get, a confirmed downtrend and we start getting chop, then the reason why I brought them up recently is because I have now been full scaled. Because the theta, there's no reason not to be doing them because the theta is outweighing any bad decisions I might make, and I'm not making any bad decisions because of how strict I am. The only bad decision I made was I swung a Tesla covered call over the weekend, and that was because I was talking to Zink about it, and the theta decay was pretty harsh. But that was the only stupid decision I've made.
Yeah, that sounds pretty bad. I wouldn't do it over the weekend, but
No.
like just if you do it overnight, that's totally different. But like literally,
Nick, look at the theta decay for the triple leverages, and you'll know why I'm doing cover calls on them.
Yeah, I mean, just like on Tesla, if you're able to get that movement. Well, I'm doing iron condors this week, but so
it makes sense to me. That would make sense to me. You're winning you're winning the same way I am. I just need slightly up or slightly down or sideways for me to win covered calls.
Yeah.
The market would have to have a disgusting move to the upside in order for me to lose my covered calls. And then I just roll them over, and then the next week we're red, and then we're good. It's again, I know that a lot of people want to learn how to day trade, but there are also ways to day trade once you start to build up a little bit more capital that are extremely high probability and put all of the variables that are against you in day trading in your favor. But it is a different strategy, requires a different set of skills, and it requires capital, which is why not a lot of people listen to me. There are a lot of people in the live call that listen to me, but outside of it, there's not a lot of people that listen to me. But the cash flow I return, I mean, the TQQ long calls I have, I'm returning anywhere from 5 to 8% a week in cash flow on the long calls.
Yeah.
So I'll give you guys an example. If I put $100,000 in my long calls for TQQ, I'm making 5 to 8 G's a week.
That's a lot.
Give you a little math on the table there.
Yeah. I was at the EXP shareholder summit and I met a couple of people on my team because obviously if you know how it works, it's like I'm a part of like a team of like 1,000 agents here in Orlando.
Okay.
So I wanted to meet you. I have like 2 guys I want you to meet if you're interested, and because I know you're looking for investment opportunities, and I'm like, bro, you gotta meet. And then there's just 2 guys I need you to, if you want to get on a call with them.
I would love to, Nick. I'd love to. Anything I can do to help you, anything I can do to help them, I'd be happy to.
Well, are you? No, this is for you. I'm here to help you.
Well, I appreciate that. I would love to talk to him.
Yeah, because I know a guy. He's like, I guess he was like the top agent in Florida. I guess a couple of years ago. But now he's managing investments, so he gets like a 22 cap rate for his clients.
So he's managing investment properties, commercial and residential?
Well, he's just managing he's a pretty analytical guy. Like he's like you, but like 10 times even more with the numbers. So he has a whole process that he does, but I would love to get you on a call with him. That's why, because I can't explain it. It's pretty complicated. So
that's all right. No, I'd be happy to get on a call, brother.
Yeah.
I'd be happy. You've got a couple different ways you can contact me that we've already chatted on. So
yeah.
Whenever you want to get that set up, let's chat. Right now, just to make this public, guys. This is really the So you guys know that I have a consulting company, which I will be sending out another announcement out on Monday to work with me. There's multiple portions to my consulting company. There's the one-on-one educational element where I help people directly, and I share everything that I'm utilizing, the models, everything. I go through everything in strict detail, and we spend a lot of time together so that you understand everything that I understand. That's the educational side. The consulting side. I am a contracted CFO. Okay, so I come in and I look at company internal financials and I go over debt to income ratio, I go over expenses, I go over a lot of different things, and I pair that with asset management for the company. Okay? And I create additional cash flow and amplified returns so that the company can expand quicker. So I work with big businesses and I manage assets for big businesses. All right? If a company is trying to buy one rental property a month, and they got a lot of liquidity that they sit on, I cash flow the liquidity, and then I bump that up to 2 to 3 rental properties per month. Okay, that's what I do. And it took me a long time to be able to get to a point in the market where I could do something like that. I can now, which is why I'm offering it to people, and it's yielding great results and companies. So I also have a fund. I'm a partner in an algorithmic fund that has taken my model and algorithmatized it. So it's very accurate. And the annual returns are phenomenal. So if you guys have any questions about that, or if there's anything I can answer for you all, please let me know. I'm happy to answer anything. I'm fully transparent about everything that I do. So, and Nick, yeah, I'm, I'm hoping, I'm hoping Tesla bear flags here, but we shall see. We shall see. Powell is on right now, guys. Let me see if I can pull that up on CNBC. See if they're showing it.
I'm up like $10, bro, off one call. I don't even know if I want to hold this, to be honest. Oh, there we go. Take that back. Nope, I'm up 50. That's real. $62. Let's go. Jeez, man, what the heck? I'm up $80 now.
Well, what's your profit target? When are you taking profits?
No clue. When I'm up at least 1,000, I'll take some profit.
Are you starting to understand the problem with the answer you just gave me?
Yeah.
Okay. So, one of the things that we preach, you do not go into a trade under any circumstance unless you have a plan to stop yourself out at a loss or a plan to get yourself out at a gain. You need to make sure you understand everything that could go right or go wrong within a trade. And once you have controlled those variables, they become far less of an issue. Okay? And you need to make sure that you are doing that before you get into trades. That goes for everybody. Getting into trades, seeing how they work, and seeing how much money you can make out of them is going to put you out of the stock market very quickly.
Jeez, I'll get out now. Jesus, okay. All right,
And based on the way that SPY's chopping right now, there's a high probability we get rejected here. So just be careful, please.
Oh yeah, no, I got filled. I got filled already. Yeah, I mean, I could have made 100, but I just got out for like $35 profit. Whatever.
Do not look at the numerical return. Everything should be percentage based, right? If I trade with $1,000 and I make 20%, I'm going to make $200. But if I trade with $100,000 and I make 20%, it's 20 G's. Okay, so please look at the percentages. Do not look at the dollar amount. The percentages is what's going to keep you consistent. Looking at dollar amount attaches emotion.
Looks like Apple wants it too.
Anyone know where J Powell's speaking at? Where the link is?
Good morning, you beautiful degens.
Oh. All right, enough with the degen shit. Good morning. I don't know who that was, but good morning. I think it was Maker. What's up, Beast?
Yeah, I just joined.
Howdy. We're already having.
You trust me like that.
We're already having degen issues this morning. So let's just.
Yo, Bo, I was in SPX right off the bell. I'm in an SPX call. Hang on, give me a second. I gotta get back in my truck and I'll tell you what I'm in. Oh, let's see. I'm in a 3850. It was cheap. It's getting there. About it is kind of like in between. $38.25. Ain't bad.
We've got two resistances: a pre-market resistance at 377.89, and then the alert I set this morning at 378.72. So we haven't broken either of them yet. But if Powell's questioning yields good results, then chances are we'll probably break both of those resistances.
Do you think above 378 would be a good thing for SPY?
Would be a good thing for SPY. Any break, any multi-break of resistance is great, and we are ever since 362. We are in a short-term uptrend, and that would create a continuation of said uptrend.
Yeah, because I'm looking above 378. Kind of looking there.
Tesla was supposed to be at 650. What happened?
It's a bear market rally, Clayton. Calm down.
All right, looks like I'm gonna have to roll my contract over. Cry myself to sleep tonight. COB. How much is the theta decay on those contracts?
Probably a good chunk.
All right, theta decay on the contracts for Tesla. Holy crap! 50%, 70%, 80%. Oh my god. Okay. All right. Well, we'll see what happens tomorrow.
That's foul.
Going swinging another. See, it is foul, However, it's quite beneficial because I make money off of Theta Decay.
Yeah, good point. Good point.
Right? So if I come in and I sell a Tesla call for, $1,000, and the next day it's down 80% to Theta,
That's all just straight back in the pocket.
That's an $800 swing right there. That's gonna pay off. That's gonna pay off my daily food eating. I'm just kidding. Just kidding. Just kidding. I do not eat Wagyu every day. Oh, real. It'd be a nice thought. All right, look. Okay.
It would be.
Okay, guys. I'm not here to tell you that I'm right or wrong, but what I am here to tell you is that we are chopping around a shitload. Right.
Yeah.
So effectively, TA wise, that would look like a bull flag, and we broke right out of it to the downside.
Exactly, bro.
So
we are SPX calls.
Say it again.
Did anyone hold those SPX calls? Did you? Wait, why didn't you sell?
Are you still in them?
You should have sold, bro. You were up like a good amount. Bro, how much contract do you have? One? Bro.
I mean, okay, just think about this. Let me just give you guys an example. If I say, all right, if I say my risk is between $100 and $300 per trade, and I buy one contract that's worth $100, I can risk the whole contract and not break my RM. Okay? But if I take a trade and I've got 5-10 G's in it, and I only want to lose, $200, I'm only risking 2% of the 10 G's. But I'm still keeping my RM. All right? Find a number or a small range that you are willing to risk per trade, and make sure when you win, you are making multiples of that risk. Usually my risks are between 10 and 5 to 1. 10 and 5 to 1 when I day trade. And I do not day trade that much.
Is anyone else looking at Logan's Boeing put?
Ooh, that would
feel your way.
I don't even have to look at Boeing's chart to know that that's probably a good trade.
Oh, $400. I don't got. Oh my god, I only have 200.
Everyone's got to start somewhere, buddy.
Yeah, I had a 5K account. I blew it all.
Oh yeah. Not a good feeling.
We've been talking about that for what, 40 minutes now. So you got to trade with a plan, and you have to know how to establish a plan.
Yeah. Yo, should I swing this Boeing plan to next day? Or tomorrow?
That is not something I can necessarily answer. That has to be your decision. What do your rules tell you? Do your rules say that you can swing a next day expiration option?
I mean, it's out of the money, so I'm not gonna. I'm just not gonna buy.
I mean, are you willing to wake up and that contract be worth nothing? That should be the only question you ask.
Yeah, nah.
That's a good answer. Okay, so to confirm our downtrend for the day, SPY is going to have to break low of day, but right now we are squeezing very tightly and we still have buyers present. So unless we flush low of day, I'm not going to be in the out of the channel camp yet. But
2021, I don't
that level that I'm referring to is 374.79, 374.80.
Inflation.
We break below that. That's going to confirm a larger downtrend for me.
Today here, there's
We've got pre-market support.
Will do. Much of this rests on your shoulders. So Chairman Powell, I just ask that as you make your decisions, you think not just of the numbers and the economics, but of the importance of sustaining this nation's democracy.
Thank you, Mr. Himes. I now recognize the ranking member of the Subcommittee on National Security, International Development, and Monetary Policy, the gentleman from Kentucky, Mr. Barr, for 1 minute to give an opening statement.
As we face the worst inflation the country has seen in 4 decades, I am encouraged to have Mr. Powell leading our central bank, and I'm hopeful the Fed will rise to the occasion. At the same time, it's important to remember the following. Just last year, Democrats were ignoring inflation warnings to pass a $2 trillion stimulus bill. They were pushing the Fed to solve climate change and social ills, and they flirted with unconventional monetary tools like yield curve control. Today, as gas prices top $5 a gallon, these left-wing ideas seem like a fever dream from an alternative universe. But many Democrats fell for them at the time, and they'll likely pursue them again if inflation subsides. The lesson for the Fed is clear. It needs to focus on doing a limited number of jobs well and not get distracted by those who want it to be all things to all people. Specifically, the Fed should be laser focused on its price stability mandate. And even as you acknowledge the risk of recession and as everyone desires a soft landing, I encourage the Fed to have fortitude to prioritize defeating this inflation scourge. Chair Powell, I hope you are hammering this message home at the Fed as ordinary Americans see their paychecks eaten away under Democrat mismanagement of our economy.
I want to welcome today's distinguished witness, the Honorable Jerome Powell, Chair of the Board of Governors of the Federal Reserve System. Without objection, your written statement will be made part of the record. Chair Powell, you are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. And I'll begin with one overarching message. At the Fed, we understand the hardship that high inflation is causing. We are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.9%. The available data for May suggests that the core measure likely held at that pace or eased slightly last month. Aggregate demand is strong, supply constraints have been larger and longer lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and fuel and is creating additional upward pressure on inflation. And COVID-19 related lockdowns in China are likely to exacerbate ongoing supply chain disruptions. Over the past year, inflation has also increased rapidly in many foreign economies, as discussed in a box in the June Monetary Policy Report. Overall, economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we have seen in recent months should continue to temper growth and help bring demand into better balance with supply. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historic highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. A box in the June Monetary Policy Report discusses developments in employment and earnings across all major demographic groups. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and price stability for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials, like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. With inflation well above our longer-run goal of 2% and an extremely tight labor market, we raised the target range for the federal funds rate at each of our past 3 meetings, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. In May, we announced plans for reducing the size of our balance sheet and shortly thereafter began the process of significantly reducing our securities holdings. Financial conditions have been tightening since last fall and have now tightened significantly, reflecting both policy actions that we have already taken and anticipated actions. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. We will make our decisions meeting by meeting.
Is going up, down, or sideways.
Our overarching focus.
Okay, I want you guys to make money all of the time.
And to keep longer
all the time,
expectations
with as little risk as humanly.
Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We're highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well-positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you very much, Chairman Powell. Chair Powell, at your Senate confirmation hearing, you were asked about the possibility that inflation is being driven by corporations in concentrated sectors of the economy. You said, and I quote, "That could be right. It could also just be, though, the demand is incredibly strong and that, they're raising prices because they can," quote, unquote. We're all seeing and feeling the effects of inflation on consumer pocketbooks, but corporate profit margins are not hurting. In 2021, the profit margins of the S&P 500 index surpassed 12%, the highest profit margin on record, and is expected to be even higher in 2020. Corporate greed and consolidation are driving higher and higher prices for consumers above and beyond any inflationary pressure.
Warning on him,
just last
even though he
quarter,
was talking about
Tyson
T-shirts being
Foods,
too tight for
which
his arms.
sells one
Nope,
out of
feety
every
feet.
5 pounds of meat sold in the United States, claims
So that's the
that their
beautiful thing
higher
about
prices
Discord
are due to
and
rising
this country.
labor and freight costs. Yet
There's certain
they
platforms
still
that will allow
managed
you
net
to
an
discuss
additional
anything.
$500 million in quarterly
Now,
profits.
doesn't mean we need to
When
go
it
off the
comes to
rails
rents, a corporate landlord
at
recently
all.
remarked, and I
I'm
quote,
just bringing that
"We
up
have an
to know that
unprecedented
you guys can
opportunity
speak your
to
mind,
really
talk
press
about
rent
whatever,
on
and you will
renewals
receive the
because
utmost
the
respect
country is
from
highly
me.
occupied."
And if
And
you
so,
receive
where are people
disrespect
going to
from
go?
anybody else in this
They can't
live
go
call,
anywhere. We
watch
have a
them
tremendous
disappear.
opportunity to press
That's how it
both
goes.
on renewing leases
Okay? I want
for
everybody to be able to speak
existing
their mind,
residents
regardless of the
and to
side of the aisle
reset
they're on.
market rates, which we've
But if you are
reset
met
numerous
with
times, even this year, end of
counterpoints,
quote. This kind of
be
blatant
respectful to the
profiteering
counterpoints.
on the backs of hardworking
All right?
families is simply outrageous. Could you
Man,
elaborate
all
on
this
the
DJ
role
talk's got
that
me in
corporations
straight
play
monk
in setting
po kung
prices
fu
and
mode.
how that is affecting inflationary pressures today.
I'm
Could you
gonna stop the
also
preaching
elaborate
before I
on
start.
what you
But
meant when you said
Rosenby,
perhaps corporations
I
are
love you
raising
guys.
prices
You all are
quote,
just nice
because they
people.
can?
Like all of the Canadians that I'm friends with, they're just
Sure. So,
nice people.
matters of concentration.
I'm not
in the
talking about you,
economy,
Rosenby, but I don't care what side of the aisle
present
you're
a
on. If
series
you're a
of interesting
kind, respectful
questions that
person,
are
I
largely
do
not
not
settled.
care.
For one thing, it is clear
I
that
just
our economy
don't.
has become more
I
concentrated.
don't care what your opinions are. I don't
largely
care about
due
anything.
to
If you
lower
respect
levels
me
of
for who I
formation of
am,
smaller
and I will
businesses,
respect you for who you are,
it is not at all
unquestionably.
clear
There's
that there's a
no
connection
discussion.
between
And every
a more
single
concentrated
Canadian
economy
friend of
and,
mine,
for example,
unbelievably
inflation. Of course,
kind,
matters of
very
corporate
open.
concentration are outside the jurisdiction of the Fed. We really, those are for the competition authorities and really not for us to discuss. In terms of why prices are going up, I think a lot of it has been, a lot of the places where prices have gone up quite a bit have been situations where supply is constrained and demand is very strong. And so
Hey,
take
Clayton.
cars, for
Yes, sir.
example. Demand
How
for
do I
cars
report
went up
a
a great deal
fake account or a scam
during the
account or
pandemic.
whatever?
People wanted to
Is
ride
this
the
on
cars
Instagram
rather
or
than
Discord?
transportation.
A Discord. It was a DM.
Wanted to move to the suburbs. and
All you
things
have to
like
do, see
that.
the big,
Rates were
see the
low.
big red
Economy
report
was
button
stronger
right
than
on the DM, right on the top of the DM.
Yeah.
But the companies
Nail
couldn't
it.
really make more cars because they
Okay.
couldn't raise their output because of the lack
And then
of
it will,
semiconductors. So
it'll
when
Discord will
demand
most likely
hits
close that account.
fixed supply, what
Oh, okay.
happens is
I wasn't sure if you
prices
guys
go
banned
up,
those accounts
the margins
personally.
went
That's
up.
why.
And
I left
so
the
I
server.
think as the economy returns
Can you
to normal,
just message me the name, and
expect
and
those
if
profit
they're
margins
not
to
cleared by
return to
Discord,
more
I'll clear them
normal
myself.
Okay. Got it.
Well, Chairman Powell,
I might
the example
I
that
might
I
have gotten
gave
that
of
message as well,
Tyson,
but I reported it
who
immediately, and
said
it's not
their
in my chats
prices are
anymore.
rising because of labor
I got
and
a
freight
spam chat
costs,
this morning.
and yet they managed to net an additional
Just
$500
shoot me a
million
message, brother.
quarterly profits. That
I apologize. I'm having a hard time hearing your words. I'm sorry.
I'm looking at all the profile pics right now of
the
everybody in the
example that I
chat.
gave of
We
Tyson
got
Foods,
Austin,
and the fact that they
operated
said
out right now.
that
Not gonna
their
lie,
prices
Austin.
were
Not
rising
gonna lie.
due to labor and freight costs. Yet they
Got
managed
some
to
radios there.
net an additional
Some
$500
radios
million
there.
in quarterly profits. How do you explain
Say it
that?
again, Austin.
I'm not
Thanks, boss.
familiar with their
Is
with
that
their
you,
profit
brother?
and loss statement, but I
Yeah,
will
man.
say, and again,
What branch?
there may be particular
Marine
industries
Corps.
where there are competition issues.
Okay. You mind if I ask what you
It's
did?
really not our
Radio
focus or our
operator.
authority.
That
Well,
would
do
make
you have
sense.
the opportunity
It was the first fucking thing
to
I saw was the
look
radio.
at
I saw it's
rising
just like,
costs
okay,
and
understood.
identify corporations
Makes
where
sense to
they
me.
are
I've
gaining
got
substantial
Marines,
profits,
Navy,
yet
Army,
they keep
police. I got
raising their
all of
prices?
my
Do you
contacts
have
before
a
I
way
started diversifying in
of
the entrepreneurial
examining
world.
that?
Everybody, all of my
I think we
fundamental
can see that,
contacts,
but
family,
I think,
friends,
you know,
work
our
contacts,
job is to
etc.
keep, you know,
They're all military.
maximum employment and
They're all
price
military.
stability. So we're not in the business
Big,
of regulating individual
big
companies.
fan. I almost
Or
went into the Army.
determining
I
whether
had
an
a
acquisition, for
geospatial
example,
engineering
are going to be
contract and a
competitive
cyber.
or that sort of thing. That's more for elected people and also for the competition authorities. So we do look at that. But again, I think a great deal of the price increases that you saw were a matter of supply being unable to meet demand, and the result was prices moving up. In many cases, that was the story.
Thank you very much. The gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee, is now recognized for 5 minutes.
Thank you, Madam Chair. I would, on this debate about corporate profits, I would commend to the committee Secretary Yellen's statement where she rejects the idea of corporate greed is to blame for inflation, and I concur. We have a complex set of issues. The fiscal house was certainly different than monetary policy, and the extraordinary nature of the partisan American Rescue Plan and $2 trillion injected into a recovering economy and Democrat policies to keep people out of the workforce for longer than the rest of the Western world also contributed to inflation. So that is a political debate here on Capitol Hill, Chairman Powell, and that is on the political side. What I want to ask you about are the policy tools that you are using. Now, certainly you, as chair of the Fed and the Open Markets Committee, took extraordinary measures in the midst of the pandemic to ensure that we didn't have further contagion, and including extraordinary lending facilities, purchasing securities, keeping the federal funds rate at zero. These were the right tools at the right time. On the fiscal side, you had a partner with bipartisan bills to keep our economy afloat during government shutdowns. But like all the good firefighting measures, we should put them away when times change. I want to talk to you as you put these measures away, how you expect the economy to respond. So let's start here. What is your level of commitment to fight inflation?
Well, so it's unconditional, our commitment is. And the reason is that we need to, in a particular situation, we have a labor market that's sort of unsustainably hot, and we're very far from our inflation target. We really need to restore price stability, get inflation back down to 2%, because without that, we're not going to be able to have a sustained period of maximum employment, where the benefits are spread very widely and where people's wages aren't being eaten up by inflation. Really, it's something that we need to do, we must do, in order to have that kind of a labor market. We'll need to do it.
So as you pull back these emergency measures from COVID, and you normalize rates to what they look like sort of in the long run, how do you expect the economy to respond?
So when we raise interest rates, and also to a lesser extent when the balance sheet shrinks, what happens is rates go up across the economy and financial conditions generally tighten. And you can think of it as in interest-sensitive spending is an important place that'll be affected, and that's things like automobiles and other durable goods. If rates are higher, then demand for cars will moderate, will decline a bit. The second channel would be asset prices generally. We don't target any particular asset prices, but higher interest rates tend to bring them down broadly. That tends to mean a little bit less spending out of because people's wealth has perhaps declined a little bit. And the third channel can be the exchange rate, where that also has disinflation effects. So overall, we have these effects on the economy. Our intent, of course, is to bring inflation down to 2% while preserving a strong labor market. As I've mentioned, that has become significantly more challenging with the events of the past few months, particularly the war, which is driving gas prices up and raising energy prices and also food prices and disrupting supply chains further.
So at the same time, you have a massive balance sheet. First begin with mortgage-backed securities. As we have a roll-off of the Fed's balance sheet of mortgage-backed securities, what are expectations for how that affects housing?
So I think what will affect housing is the rate. The housing industry and market are slowing down from a very, very hot pace, and that's partially because of higher mortgage rates. The effects of shrinking the balance sheet will be marginal compared to the effects that we're seeing and expect to continue to see from rates rising mortgage rates.
But what are your expectations and any further announcements? Can we expect further announcements on the assets you hold and the securities you hold? Or are there going to be balance sheet announcements in the coming weeks?
No, I would say this. We have a plan. We've articulated it. The markets are forward-looking. They see it. And the markets are in a good place, I think, understanding what we're going to do. And that's we're going to be allowing these securities to mature and run off our balance sheet at a pace that we've said. And it'll be 90 or 95 billion, I guess, by September. Now it's about half of that. So that's what we've done, and we expect, the idea is that that'll just be on an ongoing basis in the background, and we think the markets can handle that. Treasury issuance is way down, so we think there will be demand for these securities. The Treasury will then reissue them in whatever form they think is appropriate when it relates to Treasuries. So,
thank you.
The gentleman from New York, Mr. Meeks, who is also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Chair. Mr. Chair, it's good to see you. And I know you'll hear a lot of probably political stuff going back and forth, but the American public is trying to understand the language of which we're talking today so that we can really understand what inflation is. Fact of the matter is, I just recently was over in Europe. There's inflation in Europe, just like there's inflation here. Although, as I talked to Christine Lagarde and others, they say the cause of the inflation may be different. So if the causes are different, they said that maybe demand here, but not a case of demand there, is to resolve inflation in Europe. For example, I was in Moldova, 30% inflation rate, gas $15 a gallon, turkey 80% inflation rate, gas $13 a gallon, and I could name places in Europe from Europe to the United States. Is it that we had, whether it's the supply chains, the China shutdown, complete shutdown, the zero COVID policy, Russia's war in Ukraine, COVID period, isn't just a massive storm of everything is what contributes to inflation and causes it all over the world?
Pretty much. Yeah, that's pretty good.
It's a little bit of everything, right? So if I'm talking to my constituents, trying to explain to them what inflation is and what causes it, I would not single out any one thing. I would probably have to talk about the conglomerate of things, because if you take away 2 or 3 of those things, we might not be in the situation here. All of it unprecedented, all of it really out of the control of anyone. We're out of control of Democrats, out of control of Republicans, out of control of the president, out of control of other governments. Is that not correct?
So some of it is out of our control. For example, the price of oil and most of the price of food. And to your point, Europe has it's much more about energy and food prices, very difficult problems. And also they, of course, have the European Central Bank has different countries, which, and so they have to worry about the spreads between different countries, and that's a different challenge that we don't have here. The difference here for us is we actually have a very strong economy and well-recovered economy, and so more of our inflation is from demand, and we do have tools to deal with demand. That is the place where we actually can work, and that's what we're using our tools.
And some of that was because during the crises that we had to do certain things, stimulus and other things, to make sure that we kept our economy stable. I mean, if without doing those things, we would have been in trouble. So the things that we did going through COVID, the stimulus, trying to make sure people kept their jobs or kept money coming in at the time, was what we had to do. Otherwise, we would have been in worse shape or not have as strong economy as we have now compared to other countries. Is that not correct?
Yes, I would say it this way, that our inflation is a consequence of very strong demand, in part driven by supply, by what Congress did to support activity, in part driven by what we did, but also...
But that helped stabilize our economy at that time, right?
It did.
And if we did not do those things, our economy may not be as strong as it is right now.
I think that's right.
That's correct.
Our economy is strong.
And let me jump to something else real quick, because the one other thing, I know you testified before the Senate yesterday, and what concerned a number of my constituents that I talked to was the question about can we resolve inflation without increasing unemployment? Because our folks are concerned about losing their jobs and not being able to, it'd be worse if they were unemployed. So my question to you is, can you speak to what the Fed has seen during the last few years with respect to the relationship between unemployment and inflation? And is it possible that we can continue to have a strong labor market while also curbing inflation?
It's certainly possible that we can. And there is a relationship between unemployment and inflation. The challenge now is that inflation is at a 4-decade high, and some of it we can deal with, some of it is really going to be dealt with on global markets, the price of oil and that kind of thing. We can't affect those, but the challenge is we're tightening monetary policy, and that's designed to drive growth down to a level that's more sustainable and lower, give the supply side a chance to catch up, and give inflation a chance to come down and bring inflation down. That's what we're trying to do. We don't have precision tools, and we raise and lower interest rates. It affects the whole economy through many channels, and so there is a risk that unemployment would move up from what is a historically low level. Though a labor market with 4.1% or 4.3% unemployment is still a very strong labor market. Today's rate is 3.6%, and there are 2 vacancies for every unemployed person. So that's a labor market that's kind of overheated.
The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. Chair Powell, thank you for joining us again today. I just want to start by saying how sick and tired I am of the president's inflation blame game. One day it's Putin's fault, another it's the oil companies and the meat packers, or perhaps it's corporate greed. Now we're blaming other countries like Estonia, Turkey, Europe. I give you my avid assurance that no one in Missouri's 2nd Congressional District gives a rip what the price of gas and groceries are in Europe. They care about what they are at the corner of Manchester Road and Weidman. No one in this administration is willing to accept responsibility for the dismal economic situation America is in today. Inflation, sir, more than tripled in 2021, from 1.4 to 7%. And from June to the end of September 2021, inflation hovered, I think, around 5.4%, and then began a steady increase until reaching an historic 8.6% that is now crippling Americans' spending power today. Chair Powell, when inflation remains steady at 5.4% during that period in 2021, what factors played into the Fed's decision to keep rates at nearly zero during each FOMC meeting in June, in July, and in September of 2021, sir?
So during the summer of 2021, just giving us hindsight, inflation was coming down month by month. If you look at monthly readings for CPI or PCE, they were coming down month on month through September. And so that I think, told us that our thesis that this was going to be a passing inflation shock was at least plausible. I think that the data turned pretty hard in October and November, and we very much changed our position, and since then have tightened financial conditions quite significantly. So it was a matter of a few months when we were really looking at this and thinking it's going to be passing. Most macroeconomists thought that it would be a passing thing. It turned out to not have been so far, and so.
But we saw it move from 1.4% to 5.4%. So I don't, we did have a steady period of time. I wouldn't say that it was declining, but I'm just surprised that we weren't moving more quickly at the Fed. I mean, I want to be honest, sir, that the Fed, I think, underestimated actual inflation. What do you think you missed?
Well, we did underestimate it. With the benefit of hindsight, clearly we did. So it comes down to this judgment that we had to make. It has really nothing to do with our framework or anything like that. And every central bank had to make the same judgment, which was looking at the supply chain problems and the shock to labor force participation, millions of people out of the labor force. We had to decide whether that was going to be a lasting thing or whether it would kind of turn around quickly. We had very high levels of labor force participation. Suddenly they're much lower. The thought was people will come back. As soon as COVID is over, we have these new vaccines. Every American is going to get vaccinated. We'll be done with COVID by the end of the year. So basically, these supply side issues, broadly speaking, just didn't get better. There were recurring waves, and that was the judgment we had to make. We knew it could be wrong, and I think when it started to look pretty wrong, we pivoted. And
now, President Biden continues.
Like 7 months ago.
President Biden continues to say that a recession is not inevitable. As his government agencies, and Dems in Congress continue to spend billions and trillions of taxpayer dollars, burden businesses with costly rules and regulations, and on top of it, the president refuses to unleash American energy independence. The president's policies continue to take inflation-taming options, I think, off the table and hamstring the Fed's ability to focus on price stability. President Biden not only limits the energy production here in America and spends trillions of our taxpayers' money, but he also threatens tax increases and promises to cancel billions in debt. How can you still say, sir, that the Fed has a pathway to a soft landing for the economy?
Well, that's our intention is to achieve inflation getting back to 2%, and
with all I've laid out,
a strong labor market. I'm sorry.
With all I've laid out, and the increases you're going to have to take.
So, as I mentioned, I think that path has gotten more and more challenging, thanks to the effects on oil prices and food prices, really, and also the supply chains from the war in Ukraine. It was never going. We never said
not
it was
just
going to
the
be
war in
easy.
Ukraine, sir.
Well, it's the rise in energy prices and the rise in, which has been, began in February, the latest rise from February.
The latest rise. This has been going on for a year and a half. I appreciate the chair's indulgence. I will yield back the balance of my time. Thank you, Chairman Powell.
The gentleman from Texas, Mr. Green, who is also the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you for being here, Chair.
Hey, side note. Sorry, I was deafened, guys. Give me 1 second. I gotta mute myself.
Is Powell saying anything significant right now, or is he just repeating the same thing?
Well, Lauren, and you know this as well as I, the more you listen to him and the more you try to make sense of it, the more it's going to hurt your head. So just. Because people want answers, baby. Yeah. I got Phil.
Make sure that that's the right order. -13 would be.
It would be a sold call for 14 cents.
It's just because it's in the footing.
You have your laptop?
I do.
Yeah, go for it. There you go.
Well, I need the Wi-Fi.
All right. What else do I need to cover? Here we go. More TQQQQQ. I will eventually catch up to Birdie's shares in TQQ. Eventually. Why is it that I like the leverage version of QQQ? Because, well, would you like me to give you the short answer or the long answer? Short answer is if I'm going to wait for QQQ to go up, I might as well have something that's going to make me 3x more. Yes, sir. Also, the other thing is that TQQ cash flows an unbelievable amount of money through covered calls, like a disgusting amount. So let me give you an example. Are you in a trade right now? Can you look something up for me? Okay. Go to TQQ on the options chain and please look at the January 19th, 2024 contracts, please. All right. You see how those contracts right now are worth $14.50 thereabout for the 15 strike? Okay. So I got those contracts for between $12 and $13. And that contract with short-term covered calls, cash flows $50 to $100 per week, which is about a 5 to 8% ROI. So, regardless of TQQ going down or going up, the amount of cash flow I'm receiving to buy even more and create all this new dry powder for myself is very much absurd. But the problem that people have with triple leverages is they say, well, triple leverage can go down 80%. What do you do then? Well, then I make 6x. What do you mean? I buy more. Right. So if I make 5%, anywhere, let's say we'll go super conservative. If I make 2 to 5% per week, then I'm able to add to my position weekly while I'm going down into a bear market or while the market's falling. So I started with 500 shares of TQQ. That was with my companies, my personal assets, everything. Now I've got about 7K. Oh, yes. And that is because it expands aggressively. And the cash flow through covered calls is insane. It's exorbitant. And the cool part is I can buy that leap that I just showed you, and I can pay for 2 of them for the price of 100 shares. Well, now the premium's inflated right now because TQQ just moonboyed. But for the original $1,300, I could buy 2 of those, and it would be $2,600. So I would be able to control 100 shares, which means I can run 2 times the amount of covered calls. And if I didn't want to go that far in the money, I could go for a 0.7 strike, which is just $1,000, which means for $3,000 instead of $2,500 to buy 100 shares, for $3,000 I can control 300 contracts, which means instead of making $50 to $100 per week, I'm making $150 to $300 a week. Now, take that number of contracts, take the 3 contracts, and then multiply that by 10, and then 100, and you see the benefit of what some capital in these positions can do. Now, mind you, the only thing that I did not mention during that entire explanation is TQQ's growth of equity. TQQ from here is going to 3x plus, right? Because it's attached, it is the NASDAQ. So if the NASDAQ recovers to all-time highs, then TQQ will return to all-time highs. That is the short answer, believe it or not. And when I manage assets for companies, these companies want long-term growth, long-term accelerated growth, but they want cash flow to buy more assets. So I produce them that cash flow. And then when the market's up and their triple leverage is make them 2, 3, 4x, then they buy big assets. Right? And that could be anything. There's a lot of examples. So on the 5-minute, we've got some pretty extensive wicks, my friend. This might be a reversal point for SPY. Did I miss my TQQ cover calls while I was screaming at Lauren? Yes, I did. I'm kidding. I'm messing with you. I did not miss them. They're still the same premium. I just want to make you feel bad for a few seconds. What'd you say about me? Did you call me stout, Lauren? Understood. Hey man, I like to make doors sweat when I walk through them. You know what I'm saying? Okay. Question is, to swing Tesla or to get exercised? The answer is to roll over. The answer is to roll over. I'm not really going to be that far in the money though. We'll see. We'll see how the rest of the day goes. Lauren, you're trading SPX right now. Is that what you said? Okay. Well, another thing to consider when you're trading in a channel and you're squeezing very tightly, you can average down to those contracts with very low risk, right? Because if it breaks out of the channel, your trade ideology is broken. Just to throw in some TA your way. If you look at my chart on my stream, we the second candle bounced right off of the 200-day EMA on the 5-minute, and the first candle wicked it, but ultimately closed above it. Both of them did. Just something to consider. Well, and excuse me, I'm sorry. You know how bullish I am about literally everything, right? But I have to be realistic, and what I see moving forward is that I don't see any kind of reasoning unless the institutions want to jump the gun because they know what the next round of data is going to show. I don't see a reason. I'm gonna cry myself to sleep. Thank you, I appreciate it. I do not see a true bullish catalyst until we get CPI data that would prove that theory or that perspective. So as of right now, I'm still covering a whole lot. But we get closer to CPI data, I'm not going to be running any covers.
Clay, you think this next one will be higher or lower?
Are you referring to like above 8.4, 8.6, thereabout?
Yes.
I think it's going to be lower.
Okay.
I think it's going to be lower, and if it's not lower, we're going to see the S&P go lower.
I completely agree. I think Austin's also looking at like 378 and like 378.5 as a resistance. So if we can break 378.5.
I'm with you. I'm with you.
I mean, it's definitely possible, like, but from here, like, we're already an hour and a half into the market. We have to see another approximately 1% upwards to be in the money. I mean, if we do, it'd be great for us holding all this time, but we just gotta break out.
Yeah, well, you might get what you're asking for here.
Here's high of day.
If we get rejected here and it's a strong rejection, we'll most likely be heading back to open. If we do not get rejected, the previous high of day of yesterday is still my resistance, 378.72. There we go. There's a breakout, clean breakout.
There you go. Let's see if we can close above it now.
There she blows.
I think CPI is going to be the same. It won't be lower. It's going to be the exact same.
The headline that CNBC has up right now is that the market understands our current balance sheet, and then they just switched it. Labor market can stay strong while fighting inflation. Whoa. All right. Well, that candle disappeared. What the hell happened? Good. You talk about the Wayfair? Nope.
You know I did, sir. It's all right now. I'm up on it. Got a 750, up 22% right now. I didn't do it. I didn't catch it right at the bottom. I was doing something, but I got it right where. Let's see. Where we rejected 708.26 the first time. Came down and touched the cloud. It's right where I got it. That was fine.
I think I'm about to close in my XPX, dude. Like, this price action ain't it.
Yeah, it's choppy. It's guys. It is okay to get into the market and see that you're not happy, and address that you may not be happy with the setups that are being provided to you. Because again, if you go into a trade and you lose money, you're down for the day. But if you say that you see the screen, you see the charts, and you're not liking what you see, and you don't lose any money, and you walk away, you are not net negative for the day. But if you take a subpar entry and you lose that subpar entry, now you've got some profit or you've got some capital to make back.
I'm going to close it slightly right. I'm just going to mitigate my loss because the theta is just going to kill this, and we have so much upside, and the volume is just not there for me. The bulls one. Yeah. Yeah. I'll take approximately $1. I'll hold one just for you. How about 5? Yeah, like percentage wise, it's not that much. Like I definitely don't go and like full port it, but yeah. Oh yeah, 100%.
Okay. All right. Well, looks like that was a good cover for SPY and TQQ. These contracts are getting tossed now. Okay.
we just take that price. And the second piece of it is the spreads.
It's just
that
so
refineries
choppy. I
are.
mean, like,
so if refinery is at capacity and spreads are high, then you have a high spread there. And we know that the price of oil went up quite a bit. Started going up early in the year, and it's now come down a little bit in the last week or so. But those are the two things that have contributed to the spike in gas prices that we saw. We did see gas prices moving up, but they really moved up quite sharply beginning in
process and that crack spread and I down. So would you agree that increasing the supply of gas could meaningfully lower prices?
I'd say it's hard to argue with that. Sure.
Okay. Well, the U.S. hasn't built a major refinery since 1977. So, of course, as we know, this isn't a recent issue. It's a long-term lack of investment. And so with so many parts of our economy, and you actually touched on that earlier. Now, here's the question I'd like to ask you. Will raising interest rates help increase supply here with fuel? And are there other economic tools to do that?
No, we can't have any effect on the price of oil or certainly the supply of energy. And the tools are in the hands; they're not in our hands.
Okay, thank you for pointing that out. So I know that the Fed absolutely wants to play a role in bringing inflation down, but I want to make sure that we are looking at those solutions and trying to understand what better tools we have. Are there better options out there that you could suggest right here?
Honestly, we're an agency with a narrow but important mandate and a set of tools, and our focus is on using our tools. We think there's a job to do on demand, and I don't see us giving advice to Congress or other agencies on how they might use their tools.
Okay, well, I appreciate that, and hopefully at some other time we can talk a little bit further about that. I want to move on to housing here as well. In the 2010s, we saw less homes built than each of the previous 4 decades, and we're more than 5 million homes short of where we should be. Boy, do I see that all over Iowa, in small towns in particular as well. I've talked to businesses that want to expand, but they can't do so because there are not enough houses there. And so housing is one of the most sensitive areas relative to interest rates. So I want to ask the same thing here. Will raising interest rates help supply there? And are there other tools that we should be looking at to do that?
So I would agree with you. There's a problem with longer term housing supply and the difficulty of creating adequate housing. What our tools can do is they can, in the near term and medium term, they can restore a better balance between demand and supply in the housing market. You've had extraordinarily high housing price increases really across the country over the last couple of years, and that's because of a lot of demand and very low rates. And you're seeing the housing sector slow down to some extent because of higher mortgage rates now.
And so do you have anything that we should be on our radar or that we could be looking to do to assist with this?
I do think that these are issues for Congress around housing supply. If you talk to builders, and we do talk to builders, we had a group in last week, they will talk about the longer term issues, lack of supply of lots, lack of workers, lack of appropriate zoning and things like that. I mean, these are national issues.
Thank you.
Thank you so much.
The gentleman from Indiana, Mr. Hollingsworth, is now.
Situation because we fail to anticipate the future, even if that future is inherently uncertain and probabilistic. You said a few moments ago, we have a job to do on demand. I like that. And in the recent past and present, the policy signals I feel like have been unambiguous for the Fed. Inflation's at a 40-year high. The labor market is robust. Unemployment bouncing along multi-decade lows. Economic growth has been very high. But I worry that lucidity is a luxury that is fleeting. I believe the future will be more ambiguous as we head into a time where economic growth seems to be approximately zero and labor market weakness is beginning to emerge. I think those policy signals will be less clear going forward. Economic growth in Q1 was negative, albeit for reasons I think you called technical in nature, but still negative nonetheless. Q2 economic growth is currently projected to be approximately zero according to the GDP Now tracker and many economists. Weakness in the labor market, while nascent, is beginning to emerge. Still yet, inflation as a lagging indicator remains, as you put earlier this week, very, very high. I've certainly praised the Fed's tardy yet sudden total focus on price stability, which will come, as you said, at the cost of aggregate demand reduction. Technical reasons or not, America will feel aggregate demand reduction where GDP growth is already zero as a recession. So I am curious to hear your thought process in an environment where inflation is steadying and or coming down, but still yet at multiples of your target, and unemployment is escalating quickly and economic growth is negative. Tell me a little bit about how you'll think about that environment and approach that from a policy and rate setting perspective.
I guess I'd start by saying that that's not the environment we see or expect. We actually do think that growth this year, in the second half of this year, should still be fairly strong. It is coming down from the very high reopening levels of last year, but the first quarter was somewhat anomalous. Private spending was actually at a very healthy
level. Tell me about how you'll think about that environment. I assume that you could be correct, but there's a chance you could be incorrect about that soft landing prediction.
So the way our tools work, what we're trying to achieve is to have a moderation in demand so that supply can catch up, and so that'll take pressure off of resource utilization, and inflation can come down. That's what we're trying to achieve.
But inflation will come down after that fact. Demand will come down first. Inflation will lag that, where inflation remains multiples of your target, but unemployment, because of that sagging demand, goes up. economic growth is depressed because of that sagging demand. Tell me how you'll think about that environment.
So the way we think about it from a policy standpoint is of course, we raise interest rates and shrink the balance sheet. That affects broad financial conditions.
Indeed.
And that affects the economy. So the question we'll be asking is our policy rate, that's the thing we control, is it at the right level so that it's affecting financial conditions in the economy in the way that we need and intend? And
I want to know how you will intend to affect them where unemployment is going up and economic growth is negative, but inflation remains high.
Well, I think you would, in that hypothetical situation, I think you would say that would be a setting in which inflation could be expected to come down. As I've said, we'd like to see inflation coming down as well. Right. So the question is, you've got choices.
So you could move rates down or steady rate escalations in advance of inflation hitting your target as long as you saw it beginning to come down if economic conditions or your other mandate, full employment, begin to show weakness.
As one of my colleagues used to say, at every
meeting, is there anything that you're interested in running covered calls on right now?
Bring them down, rates, right? So I think, once, I think we'd have to see what's happening. We'll try to make good judgments in real time. Right. But the main thing is we can't fail on this. We really have to get inflation down to 2%. So we're going to want to see evidence that it really is coming down before we declare any kind of victory. And so I think we'd be reluctant to cut.
Well, this will have real cost to Americans, so I want to make sure that we're forward thinking about what is going on in the real economy, not just watching a lagging indicator that is inflation. And with that, I'll yield back.
Thank you. The gentleman from New Jersey, Mr. Gottheimer, who is also the Vice Chair of the Subcommittee, National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. Mr. Chairman, the most recent Consumer Price Index report indicated that the largest component of the CPI, shelter owned and rented, has increased 5.5% since last year. Estimates I've seen show apartment rental costs up 15% or more over the last year. Do you believe the CPI measure of shelter costs understates the actual increase in housing costs? And do you have any suggestions for actions Congress can take to lower housing costs for Americans in the short and long term?
There's some sense in which it might understate costs because it's not capturing leases that haven't turned over yet, right? So it's really looking at leases that are turning over.
So probably it's a higher rate.
Overall, we think it's a decent measure. It also remember that in the CPI, housing services has a weight that's double in the measure that we look at personal consumption expenditure inflation. We think that's a better, more sophisticated, a better representation of the inflation that's actually happening in people's lives. So we would tend to look at that.
Thank you, Mr. Chairman. I do want to shift to another issue that's covered in your June report. I've been engaged in discussions on cryptocurrency policy and have long warned that a run on stablecoin has the potential to stabilize financial markets. My concerns were realized in part last month when the so-called stablecoin terror collapsed. Your report highlighted the danger of that event and called for congressional action to protect consumers and financial markets. My draft legislation, the Stablecoin Innovation and Protection Act, would establish a definition and requirements for qualified stablecoin and define as cryptocurrencies redeemable one-to-one for U.S. dollars. This legislation would reduce financial instability in the markets and protect consumers and support innovation in fintech. It would create also a pathway for banks and non-banks to acquire qualified status for the stablecoins they issue. With federal oversight, do you believe non-bank entities can be reliable issuers of qualified stablecoins if they can prove they are fully backed by cash or cash equivalents?
So, as you know, we've recommended that Congress look at this, and there are many approaches, including yours. The President's Working Group did recommend that stablecoins be issued by insured depository institutions. I think it's great that Congress is looking at different approaches and evaluating those questions. What you really want, though, is you want to be sure that those entities are appropriately regulated, and in our view, in some sense, at the federal level. So, but I think that's going to be a question for Congress. You know what the PWG came up with, but I think there are different approaches.
Do you have any views on who the primary regulator should be at all? You think that's all up to Congress? Like with the OCC being would you have a problem with the OCC being a primary regulator?
For national bank charters, yes, but I mean, the thing is, stable coins are used now principally in the capital markets, as you know, around the platforms, the digital finance platforms, and that's more in the bailiwick of the SEC. If there were going to be payment stable coins, we should be involved, and if it's going to be about banks getting involved, it'll be the banking regulator. So I think it's going to be, we're blessed by a plethora of regulatory agencies in the financial sector, so that'll need to be sorted out.
Do you think that's something, given the challenges we've had in the last months, that's something we have to move quickly on? Are you concerned with how long it's taking Congress to actually act there?
I think it's very important. It's no different than any other big technological innovation. You know, airplanes, for example, there comes a point at which a new regulatory framework is needed to protect the public and create, you know, preserve innovation and competition, foster, support all that. But that time is coming for digital finance, and I think I'm encouraged that there are now a bunch of bills and you know, proposals, and that Congress is working on this. I think it's important that it get done, you know, quickly, because as we've seen, these companies can grow really quickly, and we've also seen that they can have reverses as well.
And you think overall the ideal role of the Fed in overseeing stablecoins is what? What ultimately you think long term? What's the role of the Fed?
Well, you know, so the one question is around CBDCs, right? Is if do we want a private stablecoin to wind up being the digital dollar? And I think the answer is no. If we're going to have a digital dollar, it should be done by us. We don't know that we need a digital dollar as such yet, but I think that it should be you know, government guaranteed money, not private money that is really created for the benefit of the private issuer. So that's one thing. I think also we're very important in payments. So anything to do with payments that the public is involved in, we should be involved in that too.
Thank you so much. I yield back. Thank you.
Thank you very much. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Chairwoman Waters and Ranking Member McHenry, for holding the hearing today, and thank you, Chair Powell, for being here with us. A few moments ago, Mr. Himes noted that the American Recovery Plan, I think he meant American Rescue Plan, is not mentioned in the Monetary Policy Report. Chair Powell, is it Federal Reserve practice to comment on bills passed by Congress in the Monetary Policy Report?
No.
Turning to a question that we've obviously talked a lot about today already, you have inflation and rising prices on things like food and fuel are having a devastating impact on people all across Middle Tennessee and indeed across the country. You have told us that you will not comment on fiscal policy, but you have also previously urged Congress to support fiscal spending, some of which caused this inflation, in my view. Democrats are still pushing a reckless spending proposal, although reports are that it will be smaller than the one they tried to ram through Congress late last year. So, Chair Powell, will you commit to pushing back as strongly against reckless spending proposals that would exacerbate the current inflation as much as you push Congress to support more fiscal spending during the pandemic?
So I didn't support any particular bill, but I did say that there was more to be done. And I, by the way, I completely ended that practice at the end of 2020. Was it 20 or 21? Anyway, 2020. I completely stopped talking about that publicly at all. And the reason I did it before was, first of all, I was being encouraged by leadership on both sides of the hill in both parties. They were asking me for ideas. Don't you think we need to do something more? Can you help us? That kind of thing. But that's all done. That's over with. And the Fed should not play or seek to play a role in fiscal policy. We have our own mandate. We sure need to stick to that now.
In light of that statement, would you agree with this statement that the analysis that the Fed had through much of last year and that the administration to some extent continues to advance, with respect to inflation and the policy prescriptions has proven to be far more transitory than the inflation itself?
Well, if I understand your question, we did think that these were going to be passing forces. We thought that these shocks that we're hitting, and supply side shocks, we thought they would be like oil shocks have been, where they come and go, and other supply side shocks, commodity shocks of various kinds. As the course of 2021 went on, it became increasingly clear, particularly in the fall, that wasn't going to be the case. We weren't going to see that kind of progress, and we pivoted. 7 months ago now, we pivoted to address this with our policy tools. I think our judgment in real time proved to be incorrect, but it was not an irrational judgment, and it was one that was very widely held at the time by other central banks and economists generally. And it wasn't about economics. It was, how long is this going to last? Are these things that are happening to our economy, which are unprecedented, are they going to get better? Like, for example, millions of people dropping out of the labor force, or the problems we have with the global supply chains. There was no model of that. We can't look at the last 20 times it happened. So that's, for sure, in hindsight, it was not transitory.
Thank you. The Committee for a Responsible Federal Budget estimated that canceling federal student loan debt held by Americans could increase the inflation rate as much as 0.5 percentage point and would add $1.6 trillion to the national debt. This estimate notably also did not incorporate the possible effect that student debt cancellation would have on increased college tuition prices. Chair Powell, has the Fed done any analysis on the inflationary impact of these proposals to forgive student loans being actively considered by congressional Democrats in the administration?
Not that I know of. We would look to CBO and legislation. We tend to start to put it in our models of the economy when we think there's really likely going to be legislation.
Generally, though, would you expect forgiving $1.6 trillion in debt, whether it's student loan debt or credit card debt, to have an inflationary impact?
Well, I'm going to leave that to CBO to score, and also the Office of Management and Budget. We just routinely do not score congressional proposals. It would get us involved in political things, and why would we be independent then? So to be independent, we need to be out of these very difficult fiscal issues, which are really your job.
Thank you, Chair Powell. I yield back.
Thank you. The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you, Madam Chair. Chairman Powell, without question, the Fed has a role to play in healing our economy. But as with any treatment, the wrong medication can cause even more harm and make the patient more ill. Chairman Powell, at your latest press conference, you stated, quote, wages are not principally responsible for the inflation we are seeing, end quote. I certainly agree with that assessment, as do many economists. Considering that wages are not driving inflation, why is the Fed addressing inflation with tools which primarily impact wages, such as interest rates?
Well, our tools principally impact inflation, not necessarily wage inflation. So our job is price inflation. But I will say on wage inflation, the issue is that over time, wages are really very important. Over time, looking forward, are very important, particularly for service companies where most of the costs are really in wages. And wages, we all love to see big wage increases, but these increases that have been having, some of them are just substantially bigger than would be consistent with 2% inflation.
Thank you. Well, throughout today's hearing, to that point, you've indicated that the Fed doesn't have more precise tools at your disposal. Chairman, the root causes of the inflation we are seeing are supply chain disruptions outside of the Fed's control, whether it's COVID-19 lockdowns in China or the Russia-Ukraine war, which is why this knee-jerk response to raise interest rates is so alarming. The Fed cannot control the factors causing inflation, but this policy choice would plunge millions of people back into unemployment, dampen wage growth, and tip the economy into a recession. There's an old adage, Chairman Powell, if all you have is a hammer, everything looks like a nail. You've recently said that the Fed's tools, like interest rates and the balance sheet, are famously blunt and lack precision. So in that case, do you agree that the Fed needs new tools that are more precise to better fulfill its statutory mandate of price stability and to maximize employment?
No, I don't think we're looking for new tools. I would just say that a big part of the inflation that's happening is really not going to be affected by tools, but a big part of it is going to be affected by our tools, and that's the part that's related to demand.
Mr. Chairman, but by your own account, you stated on the record that the Fed's current tools are ill-suited to deal with the inflation we are seeing. So perhaps now is the time to expand the Fed's toolkit to meet the unique moment that we find ourselves in. For example, one tool that could help the Fed tailor a more precise response to inflation is direct credit regulation. This would allow the Fed to regulate the availability of credit in the specific sectors of the economy experiencing high inflation without impacting other sectors. Would you support Congress passing legislation to give the Fed more precise tools to tackle inflation, such as this idea?
That's not something we would seek. Of course, it's up to Congress to make those decisions, though.
But at your own admission, your tools are too blunt and not precise enough. So what additional tools do you believe the Fed needs to respond more precisely to inflation?
Well, again, our tools they're blunt, but they are the right tools to deal with broad aggregate demand, and that is a more important determinant of inflation than energy and food prices. As painful as energy and food prices are, the bigger piece of it is related to demand. We can't help with energy and food prices, to your point, but we can help with aggregate demand, and we do that through the tools we have. We're not seeking a deeper involvement in the economy like you're talking about, but again, that's a question for Congress. Congress can change our toolkit or our mandate.
Well, in this moment of overlapping crises, from supply chain disruptions to high inflation, I do believe we need precise policies that respond to the needs of the American people. The Fed knows that raising interest rates will not address the root causes of rising prices, but they will just keep doing so, even at the cost of millions of working class people's livelihoods. We need a more sophisticated toolkit for the era we are in to truly heal our economy and tackle inflation responsibly. Thank you. I yield.
Thank you. The gentleman from Wisconsin, Mr. Stile, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. Thank you for being here, Chair Powell. Appreciate it. Just a point of clarification. You noted that you ended your public statements in support of fiscal stimulus by the end of 2020. Is that correct?
Yes.
And so it'd be after that the Democrats, under one-party control, passed $1.9 trillion of additional fiscal stimulus. After it had already stopped making public statements in support of additional fiscal stimulus. I have the timeline correct?
Yeah, I mean, again...
I'm not asking you to opine. I just want to make sure I had the timeline correct.
I took no position publicly or privately, and neither should the Fed chair do so.
Understood, but your public statements in support of additional fiscal stimulus ended in 2020. Yeah, the Democrats, under one-party control, passed $1.9 trillion of fiscal stimulus after that period of time. I just want to make sure of the timeline. I understand. Let me cognizant of the time we have, and you've noted that you think the Fed should not play a role in fiscal policy. I have grave concerns of the fiscal policy that we've seen playing out in Washington. Not asking you to opine on that. Looking at 2021, we saw real GDP growth about 5.6% in that year. Is that correct?
Yes.
Over 5%, a reasonably robust rate. And at that period of time, in the year of 2021, we saw the Fed's balance sheet increase by about $1.5 trillion. Is that correct?
Sounds about right.
So at the period of time where we were seeing reasonably robust economic growth, the Federal Reserve was continuing to build its balance sheet to a tune of $1.5 trillion. And so during the year 2021, the Federal Reserve ultimately purchased about 54% of all federal debt issued by the Treasury. Is that accurate?
I don't know that. If you have the number in front of you.
I have the number in front of me. I think it's worthwhile. Roughly half of the federal debt that was issued in 2021 was acquired by the Fed and placed on the Federal Reserve's balance sheet. My concern is that hid the real cost of borrowing that was being driven by the Biden administration at that time. And my concern is that the Federal Reserve, by increasing their balance sheet by $1.5 trillion at a period of time when Democrats put forward a gigantic stimulus package, after you had stopped your public calls for requesting additional fiscal stimulus, that's all part of the problem. It's both the fiscal policy and the monetary policy coming together. But let me keep going here for a moment. The federal government paid in debt payments last year $580 billion. Is that correct?
I don't know.
That's the numbers I have. It's about 5.8% of our budget, fiscal side. And the projections of CBO interest over the next decade one of the CBO projects that it will triple to $1.2 trillion. But that's assuming federal debt remains in a range of 2.4% to 3.8%. That's the CBO's projections to get to debt payments increasing to $1.2 trillion by the end of the decade. But we're sitting here at a period of time when the 10-year Treasury yield has crossed 3%, 3.16%, I believe, as of yesterday. A year ago, that was 1.48%. So we're already approaching the high interest rate threshold that CBO has for interest on the debt to triple. Do you project that interest payments on the debt, the interest payment number that's impacted by the interest rate set by the Fed, will remain in a range of 2.4 to 3.8%, or do you believe that it will dramatically be above that?
We don't publish projections on on Treasury rates.
So as interest rates are moving, as you're doing that, I think appropriately so, to address the inflation environment that we're in, the Federal Reserve doesn't project the cost on the debt moving forward?
So internally, we don't publish, as what I said, but internally, we of course do have a path for the 10-year, for example, and for many years, it's always showed rates returning to levels even where we are or even higher. Well, that's what goes into our models, because we assume over time, for example, we're reversing, we're going to be shrinking our balance sheet by in the range of $1 trillion a year in coming years. So that'll put more supply out. That should put some upward pressure on rates. So we do. It's not our business to project this publicly, but that our assumptions are that rates will return to.
Pay attention to supports and resistances for when to enter and exit these contracts. Right? For all intents and purposes, if I really wanted to, and I do sometimes, could day trade these contracts. Right? Last Friday, this past Friday, I got a Tesla call at open, sold the Tesla call at open, and 30 minutes later, I was up 80% for well over $300 per contract. Closed it. That was it. That was my day trade. But that profit was accelerated because every second I had that contract open, since it was a same-day expiration, I was making money from theta and volatility crash.
You were buying or are you selling?
Selling, my good sir. Never.
Okay, got it.
Very sparingly buying. Damn, Spy. Okay. So, for example, right now, Ben, I am in. Where's my Spy? Damn it. I am up 50% right now on the calls that I got today, which were the 382 calls that I sold. And then the ones that I've been swinging, I'm up 40%. Those are also 382 calls.
Is anyone else watching this Fed meeting?
I've got it up on CNBC. I'm not listening to it because
This guy who's talking right now, I don't know who he is. I'm guessing he's a Republican Steyer or something. You can't read it. That's too small. What he's talking about right now is probably one of the biggest threats to the economy. It's interesting. So if you have it up and you can rewind it, watch the last 5 minutes. He's talking about the Fed, and the Fed being like 55% of all federal debt, was a buyer of 55% of all federal debt, and the impact of the 10-year Treasury going from 1% to 3% in the last 6 months. It's really interesting.
Well, you're gonna have to fill me in, my good sir, because right now AOC is talking on CNBC, and I'll pass. My CNBC is respectfully muted. All right. Ben, does that answer all of your questions? And if not, send it.
Yeah, that was great. Thanks.
Absolutely. So does that make sense to you as to why I would do something like that?
Yeah. Are there any other ones that you do? I guess the strategy on.
So, SPY, QQQ, SSO, QLD, SPXL, UPRO, and TQQ. I am phasing out of my individual securities. So, with individual securities right now, I'm only running it on Tesla. And Tesla can make some serious money, but Tesla's scary if you don't know what you're doing. And Tesla takes a lot of capital to do so. My two favorite for cover calls undeniably is SPY and TQQ. So those have got to be my breadwinners. They've got plenty of expirations, plenty of liquidity. They're fantastic. Montana, I see you in here. I haven't heard from you once this morning, brother. What's going on? Maybe he's not here. So, yeah, that's the total. Because Ben, the biggest thing is if you're going to choose an individual security to do this with, your long capital, your bullish side of the aisle capital is at risk, right? What if that individual security doesn't do well for a long time? Then you could be out of your long-term call, right? But the highest probability trade that I can make, in my opinion, is a SPY long call, almost 2 years out. There's almost no... I cannot think of anything off the top of my head that's a higher probability trade when SPY's down 20% right now. A higher probability of the long call doing well. Well, if SPY doesn't break a low of day, then it's still squeezing. Guys, are there any questions that I can answer for you all, or anything that I can go over before I hop into the trading stage and chat with the guys and see how they're doing, check up on them? Anything I can do for you all? Anything I can answer? All right. Well, if not, I'm going to be taking the rest of the day off. I am thoroughly exhausted, physically and mentally. I had a long drive in a very, very stressful environment. Basically a friggin' monsoon, and I am wiped. And I need to. I've got a lot I need to do today, tomorrow, and this weekend. I need to be clear-headed, and I need to be rested, and I need to be situated. So, I'll chat with you beautiful folks later. We'll talk to you guys bright and early tomorrow morning. Okay?
Bye, Clayton.
Thank you very much, Nick. I appreciate you. Take care, brother. Take care. Bye, guys. Take it easy. I'll see you in the morning.
Did Clayton already leave?
Yeah, he already left for the day.
All right, cool.
Hey, everybody. Hey, Miss Montana, cargo. So what's everybody doing today?
Just waiting on my PDT to get off pattern day trading.
Oh, what platform are you using?
TD Ameritrade, but I got margin call. I mean, not even margin. What is it?
Oh, holy shit.
Hey, what's going on, Montana?
What's going on? I was listening to that Powell's thing.
Oh,
fucking
jeez,
400% on SPX puts.
I called it in the morning.
That was one of
I
the
dare
biggest
all
gains.
and Buzz was here, and I think Scene was in here too, and I said, yeah, I'm thinking it's gonna be a red day today. Just seeing all that volatility in the morning, I'm like, yeah, no, not trading.
All right, well, shit. After that 400%er, I am out for the day.
You're done for the day?
Yeah, I'm definitely good with that. It could go a lot more. My target was like 372-ish, but I mean, fuck, 400% is 400.
That's
I had to
good.
take it.
Happy for you, Montana.
In at 150, out at the 7 something.
Hello.
I'm famous for my big bum.